The most dangerous moment in the SpaceX IPO is not the first day. It is not the opening bell. It is not the first green candle. And it is not the headline saying retail investors are finally getting access to one of the most important companies on Earth. The dangerous moment comes later, quietly, after the excitement fades, after the first buyers think they already won. Because the real risk in this IPO starts when the lockup calendar begins to open. And if you do not know those dates, you may become the exit liquidity without even realizing it. So before you buy SPCX just because the chart looks strong, you need to understand one thing. A great company and a great stock entry are not always the same thing. And in this case, the difference could cost investors a lot of money. Before we go deeper, hit the like button, subscribe to the channel, and stay until the end, because by the end of this video, you will not just understand the SpaceX IPO. You will understand how Wall Street structures these deals so ordinary investors react to the headline while insiders watch the calendar. This is not financial advice. This is not a prediction that SpaceX will fail. SpaceX is one of the most extraordinary companies ever built. It launches rockets at a scale most countries cannot match. Starlink has turned satellite internet into a global business. The defense side of the company gives it a strategic importance that very few public companies can claim. So this video is not about whether the rockets are real. They are real. The business is real. The ambition is real. The question is different. The question is whether the deal was structured in a way that gives today's buyer the strongest position. And when you look under the hood, the answer becomes uncomfortable. Because the IPO price is only one part of the story. The opening day is only one part of the story. The real story is supply. Who owns the shares? Who is allowed to sell? When are they allowed to sell? And who is standing on the other side of that trade when those shares finally hit the market? That is where this gets interesting. SpaceX came public at $135 per share. At that price, the company was valued around levels that already assume a massive amount of future success. Not small success, not normal success, almost perfect execution. That matters because when a company goes public at a huge valuation, the margin for disappointment gets very thin. If the company performs incredibly, the stock may justify it. But if the company performs only very well, investors can still get hurt. That is the part new investors often miss. They think the choice is between SpaceX is amazing and SpaceX is bad. That is not the real choice. The real choice is between buying a great business at a disciplined price or buying a great story at a price that already includes years of good news. And Wall Street knows this. The bankers know this. The early funds know this. The employees who received stock years ago know this. They are not watching the same thing retail investors are watching. Retail investors watch the price. Insiders watch the lockup. Let's make this simple. When a company goes public, not every share is available to trade on day one. Usually, only a small portion of the company becomes part of the public float. That means only a limited number of shares are actually moving in the market. This limited supply can make the stock look stronger than it really is. Because if millions of people want to buy, but only a small slice of shares is available, the price can rise quickly. That first move feels like confirmation. People see the stock jump and think the market loves it. But sometimes the market is not confirming value. Sometimes it is only reacting to scarcity. And scarcity does not last forever. The rest of the shares are usually locked up. They are held by founders, early employees, venture capital firms, private investors, and executives. These people often bought or earned shares at prices far below the IPO price. Some of them have been waiting for years. Some have funds that need to return money. Some have personal wealth tied up in stock that was impossible to sell publicly. The IPO is not just a celebration for them, it's a liquidity event. That means the public market becomes the door. And the question is, when does that door open? In a normal IPO, the answer is usually simple.
After about 180 days, the lockup expires. That creates one big date everyone can circle. Before that date, insiders can't sell. After that date, they can. That is why lockup expirations can be so dangerous, because suddenly a flood of shares can become available. But SpaceX did not use the simplest version of that structure. It used a more complex one. Instead of waiting for one clean 180-day cliff, the lockup schedule is broken into multiple pieces. That sounds harmless. It even sounds smarter. And in some ways, it may reduce the risk of one massive sell-off on one day. But it also creates something else. It creates multiple exit windows, multiple moments where insider supply can begin entering the market, multiple dates where the stock can face pressure that casual investors may not be tracking. And that's why the first 90 days matter so much, because the stock price you see today is not just being shaped by excitement, it's being shaped by a future supply schedule. Now, let's talk about the clause that most people will never read. There is a performance-based early release trigger. In plain English, if SPCX trades far enough above the IPO price for enough trading days, more insider shares can become eligible to sell earlier. That means a strong rally can actually accelerate future supply. Think about how strange that is. Retail investors see a big move up and think this is bullish, but insiders may see the same move and think that unlocks another exit. That is the part that makes this IPO so psychologically dangerous, because the thing that looks like strength on the screen can become the mechanism that increases selling pressure later. The IPO price was $135. 30% above that is $175.50. So if the stock trades around or above that for the required window, it can help activate more insider selling eligibility. That doesn't mean insiders must sell. It doesn't mean the stock must fall, but it changes the supply picture, and supply matters, always. Because stocks don't move only because companies are good or bad. They move because buyers and sellers meet at a price.
If new buyers are excited but new sellers are even larger, the stock can struggle. If forced buying from index funds supports the price, it can rise. If insider selling overwhelms that buying, it can fall. The business can be incredible, and the stock can still have a bad entry point. That is the lesson. Now imagine a retail investor named Ryan. Ryan has followed SpaceX for years. He watched the launches. He uses Starlink. He believes Elon Musk is one of the greatest builders alive. So when SPX goes public, Ryan feels like he finally has his chance. He does not want to miss it. He has seen what happened to Tesla. He has seen what happens when people underestimate companies attached to huge technological shifts. So Ryan buys quickly. Not because he studied the filing, not because he modeled the valuation, not because he knows the unlock dates. He buys because the story feels too big to ignore. Now imagine another person. Her name is Claire. Claire works at an early-stage venture fund. Her fund invested years ago. Her cost basis is dramatically lower than Ryan's. She is not asking whether SpaceX is exciting. She already knows it is. She is asking when her shares can finally become liquid. Ryan is watching the chart. Claire is watching the calendar. That is the difference. And in IPOs, the calendar often beats the chart. Let's walk through the timeline. Day 0 is the IPO. Only a small portion of shares is freely trading. The headlines are loud. The demand is emotional. Everyone is talking about history being made. Then the clock starts. Around day 70, the first portion of insider shares can begin unlocking. Around day 90, another tranche can open. Then more scheduled unlocks can follow around day 105, day 120, and day 135. Each date may look small by itself, but together they represent a major increase in potential supply. And that's before including earnings-related unlocks. That's where the structure gets even more important. After the first quarterly earnings report as a public company, another portion of insider shares can become eligible to sell. Then, after another earnings report, an even larger portion can become eligible. So the investor who buys on day 1 is not just betting on rockets, satellites, and revenue growth.
They are betting that demand will be strong enough to absorb a rising wave of supply. And most people never think about that. They only ask, do I like SpaceX? That is the wrong question. A better question is, at this price, with this float, this lockup schedule, this valuation, and this coming supply, am I being paid enough for the risk? That question is harder, but it is the question serious investors ask. And if this breakdown is helping you see IPOs differently, subscribe now, because on this channel, we do not chase headlines. We break down the hidden mechanics behind money, markets, and wealth. Now let's compare this to other famous IPOs. Because SpaceX is unique as a company, but the lockup problem is not unique at all. Rivian went public with enormous hype. The business had a huge story: electric vehicles, Amazon backing, Ford involvement, a massive market. Retail investors were excited, but after the lockup expired, supply became a problem. Ford moved to sell shares, and the stock took a major hit. The lesson was not that Rivian was fake. The lesson was that when early insiders finally get access to liquidity, the public buyer may be standing in the wrong place at the wrong time. Uber had a similar lesson. It went public as one of the most recognizable private companies in the world. Everyone knew the brand. Millions used the product.
But recognition is not the same as valuation support. When the lockup expired, the stock was already weak, and the expiration added pressure right when confidence was fragile. Again, the company did not disappear, but the IPO buyer had to live through the consequences of the structure. Palantir gave investors another version of the same lesson: huge story, powerful technology, loyal retail base, massive enthusiasm. But when insiders were finally able to sell, the market had to absorb that supply, and the stock felt it. This is what people forget. Lockups do not matter because insiders are evil. They matter because incentives are different. An early employee who received shares years ago can sell and still believe in the company. A venture firm can reduce exposure and still think the company has a bright future. An executive can diversify personal wealth and still keep working hard. Selling does not always mean betrayal. Sometimes it means risk management. But for the new buyer, it still creates supply, and supply can pressure price. That is the mechanical truth underneath the emotional story. Now let's bring Elon Musk into this, because Musk is not in the same position as everyone else. His lockup is longer, his role is different, his voting power matters, his public image matters, and his decision not to sell immediately can be seen as a signal of confidence. That is the headline version, and to be fair, that signal is not meaningless. When a founder stays locked for longer, investors often like that. It suggests alignment. It tells the market the person most associated with the company is not rushing for the exit. But here is the part investors must understand. A founder lockup does not eliminate selling pressure from everyone else. The founder can stay locked while employees, venture firms, and other early holders get liquidity windows. So the story can sound reassuring while the supply calendar still creates risk. That is why you cannot just read the headline. You have to read the structure. The founder may be locked, the company may be great, the stock may still face waves of supply. All three things can be true at the same time. And this is where many retail investors get trapped. They want the story to be simple. They want one clean answer: buy or avoid, bullish or bearish, genius or bubble. But markets are rarely that clean. SpaceX can be one of the greatest companies ever created and still be risky at the wrong price. The IPO can be historic and still be structured in a way that benefits early holders more than new buyers. Elon Musk can be locked up, and other insiders can still have opportunities to sell before him. The stock can rally in the short term and still become more vulnerable as the float increases. That is not contradiction. That is how markets work. Now, there's another piece of this story: index buying. SpaceX being added to major indexes matters because passive funds may be forced to buy.
If an index includes SPCX, funds that track that index need exposure. That can create demand that has nothing to do with someone personally deciding the stock is cheap. It's rule-based buying, and rule-based buying can support a stock, especially when the available float is small. This is why some investors are excited. They think if index funds have to buy, the stock has a floor. Maybe, but be careful. Index buying can support demand. It does not erase valuation. It does not erase insider supply. It does not erase the lockup calendar. It's one force among many. And when multiple forces collide, the stock can become extremely volatile. You can have index funds buying, insiders selling, retail traders chasing, institutions hedging, and analysts debating valuation all at the same time. That is not stability. That is a battlefield. So what should a rational investor do? Not panic, not worship the stock, not blindly chase it, and not reject the company forever just because the IPO structure is complicated. The smarter move is to separate the company from the entry. Ask yourself, what do I actually know today? I know the IPO price. I know the public float is limited. I know there are staged unlocks ahead. I know earnings will matter more now because the company is public. I know index inclusion may create demand. I know insider supply may increase. I know the valuation already prices in a huge future. That's enough to be patient. Patience is not weakness. Patience is an edge.
Because the market wants you emotional on day one. It wants you watching the opening price. It wants you afraid that you will miss the only chance. But great companies do not usually give investors only one chance. Apple did not give investors one chance. Amazon did not give investors one chance. Tesla did not give investors one chance. The best companies give investors years of chances. Sometimes the first price is not the best price. Sometimes the better opportunity comes after the hype cools, after lockups clear, after earnings reveal the numbers, and after the market stops trading the dream and starts pricing the business. That does not mean the stock must crash. It means you do not have to be rushed. That is the real power move. Let other people fight over the first candle. You watch the calendar. Let other people react to social media. You read the filings. Let other people buy because they love the company. You decide only when the price, the facts, and the risk line up. Here are the dates and events that matter most. First, watch the early trading window. If SPXC moves far above the IPO price and stays there, understand that strength may help activate more insider selling eligibility. Second, watch the first earnings report. This is where the story moves from private market mythology to public market accountability. Revenue, margins, cash burn, debt, CapEx, Starlink economics, defense revenue, launch cadence, all of it matters. Third, watch the staged unlock dates. Around day 70, day 90, day 105, day 120, and day 135, more shares can become eligible for sale. Fourth, watch the later earnings-related unlocks. Those can be larger than any single scheduled tranche. Fifth, watch the 180-day expiration. By that point, much of the staged schedule may already have opened, but the remaining restrictions matter too. And finally, watch the founder lockup timeline. Because once the most visible person connected to the company eventually becomes eligible to sell, the market will focus heavily on what he does or does not do. Again, none of these dates guarantee a crash. They are not magic. They are not trading signals by themselves. They are risk markers. They tell you when the supply-demand balance may change. And when you understand that, you stop being surprised by moves that other people call random. That is the habit that matters. Not just for SPXC, for every IPO, because the same pattern repeats again and again. The public hears the story. The early investors know the structure.
The public sees the brand. The insiders know the lockup. The public reacts to the price. The professionals track the supply. And when the public finally realizes what is happening, the better-informed money is already positioned. That does not mean the game is impossible. It means you need better habits. Read the filing, find the lockup section, understand the float, check the valuation, watch the earnings dates, ask who is allowed to sell and when. If you do those things, you are already ahead of most investors, because most people don't lose money because they are stupid. They lose money because they are rushed. They buy the story before they understand the structure, and on IPO day, the structure matters more than the excitement. So here's the final takeaway. SpaceX may be a generational company, but that does not automatically make every entry price a generational opportunity. The stock may rise. It may fall. It may trade wildly for months. Nobody knows the next candle with certainty. But we do know this: the next 6 months are not just about rockets. They are about unlocks. They are about earnings. They are about float expansion. They are about insider liquidity. They are about passive buying. They are about whether real public numbers can support a private market valuation. That's the real test. Not the first day, not the viral headline, not the opening pop. The real test starts after the IPO excitement fades. And if you remember only one line from this video, remember this: the price is loud, the calendar is quiet, but the calendar usually tells you more. If this video helped you understand the SpaceX IPO differently, hit the like button, subscribe to the channel, and comment below, watch the calendar. And before you buy any IPO, ask yourself one simple question: am I buying before the insiders can sell? Or am I the person they are waiting to sell to? That question can save you a lot of money. This is not financial advice, it's a framework. And in markets, frameworks beat hype. See you in the next video.